Good morning, everybody. Welcome to the Flow Show. Here we are, day after Powell, the big old day, 17th of April. Good morning to you. Good morning to K-Man. How you doing, mate?
Good morning, Ryan. Good morning, everybody. Yeah, we're doing fine. We're doing fine. Another day, another dollar, as they say.
Yep. Another euro, another quid. Well, we might have a little bit of a quieter day today, so it might be a bit of a day of reflection, given everything we've had so far. So let's get stuck into it. In Japan, Toshiba are looking to cut 5,000 jobs over there, which is around 10% of its Japanese employees. So doing a bit of streamlining over there. Over in New Zealand, we had some CPI data overnight coming in pretty much as expected, bang on the money, 0.6% quarter on quarter, 4% as expected year on year. This is Q1 data. So the quarter on quarter number going up a touch, but the rest of it coming down. Over at the ECB, ECB's Mackloff says we're pretty close to a rate cut now, but we need to be extremely cautious with decisions. ECB's Vilroy is back from his holiday, it seems. He says the expected June rate cut is to be followed by others, but with a pragmatic and agile gradualism. I'll let you work out what that means. It says after the June meeting, there will have to be further cuts this year and in 2025. We also heard from Queen Suntan as well, speaking on CNBC. So she was pretty strong on the cut language that we know is pretty much coming. It says we'll cut rates soon, barring any major surprises, and subject to no development of additional shocks. Now will be the time, or it would be time, to moderate restrictive monetary policy in reasonably short order. We need to be a bit more confident on the disinflation process. The ECB is not pre-committing to a particular rate path. Then so we must be very attentive to FX rate changes and the value of the euro, though the ECB is not targeting the exchange rate. And then overnight popped up again to say that Germany may have turned the corner after major shocks. Over in the UK, we had the latest round of data, CPI data, big data for the UK. Sticky is the main word out from that. Headline CPI coming in a point above expectations, though confirming a drop from last month. Same with the core number. 4.2 versus 4.1 expected, 4.5 prior. All the other numbers are still showing positive, so they're all plus numbers in the PPI data, except for this one, which is PPI input. So this is costs coming into producers, factories and whatnot. That's now hit its 10-month run of negative numbers. However, the output PPI is still showing positive. It was on a little bit of a mildly negative slant, 0.1s, 0.2s, but now this has completed its second month running of higher output costs. So it means costs are getting cheaper coming in, but they're still going up, going out. So that will lead to domestic price pressures remaining sticky. It also can be a bit of a margin benefit for manufacturers, if it's costing them cheaper to buy their raw materials and they're still putting up prices for their finished goods, that's a bit of a profit margin boost for them. So for an economic basis, that's not a bad thing. For the BOE and its inflationary basis, not such a good thing. But anyway, sticky inflation there, and that's been reflected largely in the quid. Rate futures, they cut around what do they cut around 8 basis points of rate cuts by December. So they now see 34 pips versus 42 before that data. Since that data's come out, though, and though it remains sticky, we've had the Prime Minister declaring victory for his policies in reducing inflation. And there's bubbles in our Chat room said it was a global problem when it was going up, but it's their solution now. It's coming down. So that's politics for you. Now, UK Chancellor Hunt may have given us a bit of a nod towards when this election is going to happen, although everyone's sort of assuming it's going to be around the autumn. But he said the feel-good factor will be stronger by early autumn. He was pining on rate cuts, but they obviously may not happen with that inflation data. But saying that the UK will have a feel-good factor by early autumn, as I say, gives maybe a little indication of when they hope the economy will be doing well enough to call an election. Sunak won't want to call an election while things are looking as they are now. If things are looking much rosier, then they will want to try and benefit from that. Not that I think it's going to make any difference in the election, but that, again, is politics for you. Kate, anything from that side of things, Europe, ECB, UK, you want to point out?
No, not really. As you say, it's all a bit sticky. It's all coming off, but by far not as fast as people would hope. We know the reasons behind that, higher energy and stuff. But yeah, I think in the global scheme of things, is it really changing much? I'm not too sure. The market is still constantly repricing when cuts are expected, and I guess with every data point coming out, we are going to see a similar thing. No, for the rest, not too much. No, it seems the ECB members are now really pointing at June, right? They're all opening the door very wide.
Yeah, it's now at the point where it'll be a shock if they don't cut in June. So as always, that's where the main price risk lies now, if they don't cut in June. But then we've also got this conundrum of whether they indicate they're going to go again in July or pause after a June cut. So that's going to be the next thing we're going to be trading. As you can see there, CPI numbers out the Eurozone as well coming in. These are the final numbers, all coming in unchanged over the flash reading. South African CPI looking sticky as well, coming down a bit, but holding up.
Exactly. No exception there. Really no exception. It's coming down gradually, but probably too slow. Sorry, too slow for any major moves. We've also seen, even though today, the rand after the CPI number, because of the stickiness of it and because risk is doing slightly better again. It's strengthening a bit, but overall the rand remains quite well under pressure. So it's there as well. It's not going to change the global picture now of the stickiness everywhere. I think the rand is eyeing at many things at the same time, higher gold, but then higher commodities as well, but doing a bit of a yo-yo, then geopolitics, because we know that they are rather looking at what's happening in Russia and China. And also, yesterday there was an interesting article in the I don't know which media it was anymore. I think it's Bloomberg, but about the upcoming elections in June, and that may be I think it's June, and that may be another moment to put in the diaries, because it's not a guarantee that the ANC is keeping their majority. So that's another interesting point to watch. So going forward, unless we get different data out of South Africa, like really clear data, I mean, not such a slow grind. I think perhaps if you trade South African rand, it's worth starting to think more about geopolitics and those elections than really what's happening on the on such data as we've seen today.
Yeah, thanks, mate. Right, looking back at yesterday's US data, a few bits and pieces out. Housing starts and building permits took a little bit of a dive, a bit of a surprising one there. Starts dropping much or coming in much lower than expected, lower than last month. Same with building permits. Might just be a little early year wobble. Not sure if there's any weather involved in that, but we shall keep an eye on that one because it was quite a decent dip on that. We also got Canada CPI coming out as well. A little bit of a mixed picture. Sticky is still the overriding theme. Headline CPI actually went up a pip to 2.9%, but all the other measures either came in a touch softer, as you can see there, the trim, the mean, the common there as well. The BOC core measure coming in at 2%. That's bang on the BOC's target from 2.1%. So things are moving in the right way. You know, we're getting a two handle on a bit more of these numbers as well. So yeah, still sticky, still not enough to push them to clear rate cut talk, although Macklem was still leaning that way in the BSE presser last week. And we'll get onto him in a moment. Over to the Fed speakers. And Fed Jefferson, he's vice chair of the Fed, says that if inflation persists, they can hold rates higher for longer, though he expects inflation to decline with the Fed rate staying steady. Says recent inflation data were above the low 2023 readings. The Fed's job of restoring 2% inflation is not yet done. Fed's Barkin said CPI data hasn't been supportive of a soft landing. And so over to Powell, or Jay and Stiff, as they wanted to call each other, this shindig last night. And Powell got straight into it pretty much. Seemingly he was on a mission to set the stall out, and he opened by saying that the recent data shows a lack of further progress on inflation this year. Said that the 12-month core PCE inflation was little changed in March, according to estimates. We've yet to get the March PCE. Said restrictive policy needs further time to work, likely to take longer for confidence on inflation. There's the old central bank word bingo card being ticked, and said it's appropriate to let policy take further time to work. I think that last line we may well be seeing popping up in the next FOMC. Maybe a shift from it's going to be appropriate to cut rates sometime this year, that sort of language, to maybe let policy take further time to work. As I said, Macklem saying core inflation downtick suggests that pressures are easing and they continue to move in the right direction on inflation. That's for Canada. Okay, the main man, not hawkish, a little bit of a nod to what's been going on, but no explicit cut language. Is that a little bit of a warning there?
Yeah, I think he's siding with the higher for longer rhetoric. But what I also found is that he's putting the bar for future hikes relatively high. That part he seems to be pushing back against. Reading through the lines, of course, he's never going to say anything openly, but it does seem that it's going to take a lot for further hikes. So, and I know people are looking at that. We always have to look at every side or every possibility, but that filtered through for me that higher for longer, yes. But and he did say that the confidence of cutting was not there yet, which is a bit pushback against what he's been saying really since the end of last year, that we were nearing. But he seems to have to well, not he seems to, he has to push back against it. But for me, the main takeaway was that he could, without any problem at all, name 10 Canadian comedians that are popular in the US. And that was, he just spit those names out like if he knew all of them personally. That was very impressive to me. So that's the main takeaway for me.
Yeah, I mean, it seemed to be a good job in shepherding the market, acknowledging that rates might stay higher for longer, but then saying don't you start getting too extreme with your hawkishness and start getting into hikes, because like you say, the bar is high for hikes, which it is. Let's face it, it is high, unless I should think inflation gets back above 4% or something, heads towards 5% again, and then I think hikes will come on the table. But yeah, he's becoming a master at shepherding the markets at the moment, isn't he? He does it at the FOMC, when he needs to say something, he'll say it. But yeah, he's grown accustomed now to keeping the markets corralled, shall we say?
Yeah, and whatever people may think of Powell, whatever people may think of even the institution, because we know we hear so much here and there. I think he's doing a relatively okay job in keeping everybody's expectations a bit under control, but at the same time admitting that, and because at the start of his speech, his first line, he kind of admitted that he was surprised by the U.S. economy not starting to roll over yet, and so that was the real hawkish bit in the whole thing. But then, yeah, he spent the rest of the speech trying to control everybody's expectations, and I think he's doing a pretty good job at it.
Yep, and going on by the price action today or over the event, he has done a good job of it. And I pointed this out in the chat room, just having a quick flash look. We've tested lows in various pairs. A lot of them been around the big figures. So euro dollar around this 106 level. We came down all through last week, quite a strong move. Get into Powell, get through some more data, and here we are. We can't get through. So this is just indicating that maybe this move is petering out. The market's done whatever it needed to do with the dollar here, and we're just potentially not going to go much lower. Same for cable in that 124 area, came down, a couple of little tests, close, can't get through. Aussie dollar down to this 64. We did have a little probe underneath, but we're back above, and now we're just moving away from it. A lot of pairs, a lot of assets, all seemingly hitting some tops and bottoms and now holding them. So I think we've got a little bit of a pause. We've had Powell now. The market knows what's what. It's done, as I say, whatever repricing or whatever it's needed to do over the last few days. Now we may just be hitting a little bit of a pause moment before we move into whatever happens next. So I think it's going to need to take something extra to get the dollar moving again, whether that's a risk headline or the next strong bit of data, or even some comments from a Fed head. But I think we might be at a point where we're just maybe going to go sideways for a bit while we wait and see what next. So if you've been short pairs like the Aussie dollar, cable and the like, be mindful of what's happening at some of these levels, because this is where the market's now saying, okay, enough's enough for now, and then we'll see what happens. If you can't get a decent bounce, though, getting back some of these levels, for example, I think we'd need to see this back towards and above 65 to take some of this pressure off. If we can't do that, it will keep the bearish mood in play. But if you're short these pairs down around this sort of zone, you want to be a bit careful that maybe we're not going to head lower for now. And if you're long down here, also be mindful that you need to see a decent bounce. If not, it keeps the pressure on here, but you know where you're going to be wrong at some of these levels. As I said, it's a similar picture in a lot of assets. Look at oil, and we've topped out a couple of times up in this 90 high 91s, 92 area. Now we're just wondering what to do next. Got some support down here, 88, 70s. So a little bit of consolidation going on. Again, we've still got that risk overhang from Israel, Iran. So the market's still going to have a little bit of a cautionary slant to it. But for want of any headlines, as Kay likes to say, the collective Alzheimer's might kick in, and maybe the market thinks no news is good news. And then we start to see risk trades coming back on board again. Gold, I still don't know what this bloody thing's doing. Even if risk is maybe abating a bit, it's still going higher. As we've been thinking, or as I've been thinking through most of this rally, it looks like there's forces at play other than risk moves, because here we are back up towards 2400 again. Stocks as well, a lot of eyeballs and a lot of people in our room. Oh, where's that one now? Trading against this support area here. It's looked a bit cracky, but give or take, it's holding. However, the bounce has been limited to this 50-80 area. So something's going to happen here. Either we're going to break down below here and really move back towards 5,000, or we're going to get back above 50-80 and move on back up towards 51. So a lot of assets sitting on the fence at the moment. And the only thing we can do is watch the price action and see what it wants to do. Kate, I'll hand it over to you nice and early because you didn't get much of a look yesterday. Clock ticking and whatnot. So over to you, mate.
Yeah. Okay. Right. Just while looking at this euro dollar, just replying straight away to Angela. Yeah, it count the dollar, yeah, but it's all one reversal trade. That's where I maybe still have a little bit of an issue. I think in the general in general, and of course this can reverse. I mean, there is absolutely no doubt about that. The market can reverse even with yields where they are. It looks as if we are rather back on a bit of the dollar following the stocks a bit train, and perhaps even dragged around with those metals. But I'm not sure whether we can talk about a reversal yet. If you mean in the really short term, it can be. As we are seeing, by the way, we are seeing the euro ticking up. We are seeing the Aussie and the Kiwi as well. Dollar CAD coming back from the highest. But so far, I'd say we are in book managing mode and corrective mode. For as long in the short term, for as long as we stay below this 106.6570, I think it's still very much going to the downside. And this may just be, as people, technical gurus call it, flagging, and we may still go lower. I think when where the picture will change, and we can talk about a potential reversal if we start to break here, 106.90, 107.10. If that starts to go, then I think we can be back in the broader range, let's say. But we may be talking about a reversal. But for the time being, if we put one after the other, let's say the main data that came out over this month so far, which is the labor report, and everybody can always discuss about the quality of the jobs, of course. That was one point actually, which I was perhaps expecting Powell to touch upon if he wanted to keep hawkish expectations in check about quality of the jobs, but it didn't. He actually, to me, was relatively upbeat still, and still talking the higher for longer line. But so, yeah, back on this euro dollar. I think for as long as we are below here, and then especially I would say, yeah, 106.90, 107.10. This is going to be an area that I'm going to keep a very close eye on. People will probably watch 107.25 again. So we already have quite a few levels as well to lean against if we see corrections for an extra move lower. That remains to be seen. I'm still nursing a bit of a short that I have since the option play, and that I've been trading around, buying back on the dips here, and then trying to lean against some of those levels, and with reduced for the time being positions, because I want to respect this 105.95, 106.10 as well. This is the next zone, right? If that goes, then we will be talking about 105, those prior lows here, low 105s, low 105s. That's going to be on everybody's mind, of course. So for the time being, I think to me, this looks a bit of corrective moves. On the dollar yen, 155 is a level, and then 156.5. But I see a lot of people talk about what Canada hinted at back in somewhere in February, I think, that a 10 yen move within a 1 month period is rapid or excessive. And since the low of the Bank of Japan, if I'm correct, let me just take my sheet back. Was the 19th of March. Here then. No, actually, here. Oh, this is we've actually done much less. But if you look at it over a bit of a bigger month, we've already done 7 or 8 big figures, and so people are sticking 156 to the expectations now, foreseeing interventions. The thing is, what I was saying yesterday as well, both Ueda and likely, and I still haven't seen confirmation of that. I don't know if you have, Ryan, that Suzuki is over in Washington for the G20. He should be.
No, I'm not, I'll have a look at the see if I can find the program.
Yeah, but the thing is, will they intervene with both Ueda and Suzuki out of the country? That's my question now. So I think the risk is that for at least the time of the Washington meetings, the G20, which are starting, if I'm not mistaken, today, there is a risk that the market is going to push up to the 156 just to test what Canada was saying, right? And again, what I've been saying already, okay, we've got some 153.60 here, but really, if the yen wants to strengthen for a more lasting period, we are going to have to break back below 152, 152.5. That is now, to me, the zone, and we are 200 points away, but we've seen the levels to the top side, doing 200 points in very quick order. Why not on the downside? But apart from interventions right now, and looking at the string of numbers that we had out of the US, the jobs report, the retail sales, and the CPI, I don't know really what's going to turn it around naturally. Okay. Next week we will talk about the Bank of Japan, because this level in the dollar yen, whatever Bank of Japan's role is, and the interventions are down to the MOF. But I've seen Ueda talk about the level of the yen, so why not do a surprise hike next week? Okay, I've already been saying it, but I think this is something now that we should start to talk about and look at, and perhaps that is going to cause the fear of a rate hike may cause a bit of a setback on the dollar yen naturally. Okay, otherwise I think it's only going to be with interventions right now. So there's a couple of interesting ones, and Ryan already said, so this 63.90 figure on the Aussie, but again, same picture as on the euro. We had the breakdown, first of all below 64.80, and then bit of a trend line here, break around 64.5. This is going to be your first zone of resistance now, around 64.5. And as long as we are below, this still looks also corrective sideways action to me, before we attacking the downside, just based on divergence in data and how the dollar is behaving right now. If we see starting to move above 64.5, I think we might see some short-term stops, taking it up to 64.80, 80.90 for a starter, before we can really talk about this big zone again, up in the low 65s. Okay, but for now, I still find all of this really corrective. One interesting one here is the Kiwi, because we're seeing this channel here, and this may look as a fakie, because we are back above 59, but we are so close to this 59. I'm having struggled to call it like a fake and going back up. It is possible, of course, but I want to see closes, and I want to see where the close is today, whether we're above or below 59. This is going to be a very nice pivot to watch, I think, for the rest of the week. Actually, do we have any more Kiwi data out? No, but we have Aussie employment next night. Okay, Aussie employment data, and I think last one was a bumper number, right? Yeah, was a really bumper number. So watch the Aussie for on the employment data coming up. And then let's talk about what's happening in the Canada after Tiff and Jay's powwow yesterday. So we had a bit of a spike here on the dollar CAD. Very short term, very short term. First support here at 138 figure 2 is already holding. But I would say that the more important one now lies around here, because we had bit of a low here, bit of a move lower here, and then the jump higher. Of course, we could call it 137 and a quarter, but I think already 137.45.60 looks interesting enough here to me. 137.45.60. If we have a setback here, if it's a stepping process to go higher, closer to perhaps 140 or 139, I have also marked here. It should hold one in the mid 137s for me. Yeah, gold, I don't know what to say really. Well, I know where it held, and that's where the zone that I was calling last time, 23.20, 23.25. For as long as we are above, it's extremely tough to stand in front of this trend, right? 2400, little bit of an intermediate zone now, but then we're talking again about those highs, 2430. I'm same as everybody else. Is it geopolitical? Is it still China or others heavily buying gold? It's not due to the dollar side, so it's purely due to metals and or perhaps just gold. You know, people want to have it, and for perhaps even the longer term and what's to come in the second half of this year. That's possible. People in the gold market can do long-term trade as well. But if it would come back down, 23 and a quarter again, 2025. Yeah. Top side, well, the door is open to possibly 2500 and God knows how much further. It is a bit of an extension level, the one that we hit before. So 2430s is going to be your resistance if it breaks back above 2400. Okay. I don't have too much more to show. This one is up and down with the rest of the dollars, but it's behaving pretty well, and already just below 91, the dollar Swiss is holding, and we are still very comfortably above the trendline break zones. It does feel that if the dollar has a next leg in it, this could finally go to where the last quarter of last year started, which is back in the 92.5s. Longer termers are actually looking for a move way above here, but I'd say one level at the time. Okay. For what I've got left, I would start to reflect if we get back into low 90s and start to worry if we break back below 90 the figure. If we get back below 90 the figure, I think psychologically it's not going to be looking good. That for the medium term on the Schweiz. Euro Swiss, it's starting to be a bit of a magic level, this 96.75, isn't it? And it's held again today, and we are starting to move back higher again. So this is your magic number, 96.75 Euro Swiss. For as long as it holds, yes, we've broken this channel here, but for as long as this one holds, this retracement hold, I think it's a pretty decent level to trade against. If it would ever break, then we're talking about low 96s or even back here in this 95.5, 95.75 zone. But for the time being, still positive vibes, still looking just corrective for me, and still looking up, I'd say. What else? Next, we had these sessions of a bit of a scare, over positioning. As I said, I mean, so many people diving into the Mexican peso that sooner or later it had to do something like this. Also on the geopolitical scare, possibly. But we are capped around fib levels here. Those are in the just above 1710 up to 1715. Can we go higher? Yes, of course. If there's something going wrong in the geopolitical front, we can go higher, or the migration front, or if oil starts to come back lower, if commodities start to come back lower, we can still move higher up to up into the 1730s again. It's all possible, but it's starting to look, because we're already back below 17, it's starting to look as if the biggest scare is over. But we need confirmations, okay? We need confirmation, and the confirmation will probably come if we get back below 1688, 1690. Then we can ease off further back into the well, mid 16 perhaps. But it's a bit of a fluid situation, I would say, for now. Similar thing on the Euromex. We have broken back above this broken trend line of this wedge, but it's already rejecting it. And look where we stopped. We stopped on levels that we've seen here in September, that we've seen here in March, bit of a rebound level before. Then we saw the break low. We tested it again. 1816, we're not far away. We're 0.5% away, which is not too far in terms of emerging markets. If it starts to go above 1820, 22, then I think there's a fair chance we are going back to 18.5. But the long term, even the medium term here, but the very long term is still very much oriented to the downside, and only breaks above 17.5, I think, are going to put the longer termers a bit in doubt. And if it starts to break above 18.5, this Euromex, then I think there may be a bit of doubt creeping into longer term positions, okay? But for as long as that doesn't happen, I think it's still, we have seen those reactions, right, in the past. This is just one of those reactions so far, okay? And it's still an 11% currency, and we will know more about it. Let me look at my sheet. 9th of May, so we still have a bit to go for the next Banxico meeting. All right, and this is about it for me today. Ryan, perhaps a quick look at the cable, which is in similar situation as well as the euro dollar. We can actually draw a bit of a line here, and I'd say 125 the figure. As long as we are below 125 the figure, the big question remains: are we starting to see a reversal, or is it just a correction in a downward move here? To me, it's still, for now, it still looks like the latter, but we will see. If we start to get back below 124.15, 124.05, it'll look bleak again for mid 123s. And that's it. Back over to you, mate.
Thank you very much, mate. I've done a bit of digging, and it seems, for all intents and purposes, that Suzuki is heading over there.
All right.
There was a Bloomberg piece out overnight saying he was mentioning comments. We are closely monitoring developments on Tuesday before his departure to Washington, because it's the IMF shindig going on over there as well. And another press source saying we will meet our friends at the G7, and that he intends to raise the issue of the sharp drop in the yen at these meetings. So it suggests that I don't know why, as I said yesterday, I don't know why he would miss it. The IMF thing as well, and the G20 thing. So good time to have a little knees up over there in Washington. Anyway, so yeah, it looks like he's on his way by those press reports. And
it would be a surprise if he wouldn't be there, because he was talking about it last week as well, right?
Yeah, exactly. But it might be a surprise that Ueda's over there, unless he's mainly there for the IMF thing, because the G20 looked like its deputy central bank governors rather than central bank heads. So, as I say, maybe he's going to the IMF thing more than the G20 thing. Who knows? They can do what they like. It's party time, as I say, in Washington. That it'll be in the bars and strip clubs, no doubt, later on. Anyway. We'll call that a day for today. Thank you very much for coming to the Flow Show. Thank you very much, Kay, for giving us all your analysis on all those pairs and assets. Have a great day, everybody. Trade safely, and we will see you all tomorrow. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.